Buongiorno a tutti, grazie.
Ladies and gentlemen, good morning and welcome, and thank you for being here with us at this Eni Investment Day. We shall present the Strategy Day and our medium to long-term strategies. Now, at the beginning of this presentation, I would like to start from the most recent event, the big initiative that we managed to complete a week ago after the Strategy Day where we held in London. That is the disposal of 25% in Mozambique, Area 4, to Exxon. Well, this is a project that we had been pursuing and discussing for some time now, and it is a very important point because of different reasons. Now, first of all, because we managed to monetize well in advance before the beginning of production of Mozambique, an LNG field. The production will start in 2021, 2022, and we managed to cash in $2.8 billion with considerable capital gains for Eni. And so we anticipated cash in. This is operating cash, which applies to the whole of our exploration model. We managed to cash in money earlier. We reduced the risk, we reduced exposure and investments that we are going to make. But in Mozambique, which is a new country for oil and gas activities, we opened this country to Exxon, which, because of getting in, paid 2.8 billion euros, but apart from this, has decided to invest in a gas asset. They carried out a thorough due diligence on the project, and by getting this stake, they kind of guarantee the quality of the project. Now, after the entry of Exxon, we have to say that this project has been certified as a strong upside for Eni and for Mozambique as well. Now, very briefly, how are we going to get organized? This is a JV which is quite important when it comes to the number of companies being part of the JV. We have a 25% stake. The same applies to Exxon. We shall share operations. We shall take care of the upstream operations, that is the offshore development, whereas Exxon will take care of the midstream development, which is what is going to be done onshore. And we shall remain the operators of the first project, i.e. Coral, which is about to be approved, and we shall be the project leader for Coral. Now, we started with this slide because this is a big novelty. But I also wanted to use this event because this confirms the soundness of a model which is applied only by Eni. That is, we do exploration work with a big stake initially, and the model that we use allowed us to cash in the money earlier. Now, you know that we usually carry out dual exploration work, but this is not an M&A activity. We sell part of the exploration, we keep part of the exploration for us, we remain operators, we develop the work, and we create future cash flows, but we cash in the money earlier. Now, this is the story of what has happened for the past 3-4 years, and thanks to the model, which, as I said, is very typical of any activities, plus $10 billion with a capital gain of $8 billion, which is very important considering that other companies are disposing of production assets, being able to sell being able to sell exploration without selling the assets. Well, for this reason, this was very important. Dual exploration is very important for cash, but it is also very important because it recognizes the quality of any assets, where we have managed to attract the four largest companies in the world. Exxon, for instance, in Mozambique. Before that, which is 4 years ago, CNPC. And then in Zohr, we managed to attract the second top reserve company, which is BP, and then we also managed to attract Rosneft, which is a national company, as you know. So the two top international companies, the two top national companies have kind of reached us, joined us. So this is a disposal operation, but it is also a recognition of the quality of our assets. We implemented already projects on these assets. The fourth largest companies, when they decided to enter the GV, had to validate our assets, had to validate our technical choices, the technologies, and our know-how. So when we speak of the dual exploration, we don't have to think only about $9 billion, but we have to kind of think of what is behind the corporate profile of Eni. Let us now move on to the next slide and logically following what I said about exploration, I'd like to dwell on the capability that Eni has to monetize projects earlier. But I wanted to show you this slide because it takes the past 3 years and it shows what we have discovered in 3 years, 3.4 billion barrels of resources. The latest discovery, 1.1 billion barrels. Very low costs. Now, the barrel cost less than $1. Last year, it was 60 euro cents. Now, when we speak of $1, we have to understand how much is the price in the industry. The range is usually between $6 and $15 per barrel. So discovery costs are certainly higher than us. We have costs below $1. This is why our costs are so low. Our costs start from the first brick, which is the exploration cost, which is quite low. I mean, imagine if exploration costs are $10 and then I have to add the operating costs and development costs, I will easily reach the level of the oil price as it is today. But what is certainly more interesting and meaningful is that in a period of 3 years, in an industry which has very long cycles, think of Kashagan or some large projects around the world, in 3 years, 50% of these 3.4 billion barrels that we discovered have already been transformed into value. 25% of such resources have become +1, which means resources that can already be developed, that is proven resources. And then 25% is what we cashed in for the Zohr disposal, $2.2 billion. So 50% of these 3.4 billion barrels have a value at the moment when they were discovered, and usually discoveries achieve their value 7-10 years after the discovery. And so it's idle capital and very high cost of capital. And financially speaking, it is fundamental to be able to start the industrial process and value the project as soon as possible. Otherwise, you will have idle capital that will certainly have an effect on our accounts. Now, the remaining 50% of these resources are already P2, P3. What does that mean? It means possible, likely reserves, which have already been proven, however, and which are already part of a sequence which will lead to the setting up of projects. When we speak of the rapidity of moving from a potential to a real project, well, this is measured in the replacement ratio. And you see that reserve replacement ratio on the right of the slide. So how much am I able to replace in terms of production value in a year? This year, our replacement ratio is 193%, which means that we have replaced 193% of the production that we have produced. And so what is extraordinary is that we are capable to transform into production what you have sold. But you may say, well, you sell and then you become shorter of reserves. Well, if we do not produce what we have replaced, it means that the production value goes down, or the replacement value goes down from 193 to 140. But in order to understand whether what we do is positive, we have to compare ourselves with our peers. Now, the average of peers, the company that you see here at the bottom of the page, recovered 30% of what they have produced. I mean, although we sold resources, we have 139, whereas the other companies have different data. Well, this is a record for Eni. As you can see, our peers have replaced 55% versus 150% of Eni. Let's go to the next slide now. And I told you about the disposal of a stake in Mozambique that occurred in 2016. So let's talk about the results in 2016. How can we characterize 2016? Well, that for Eni was a strong, difficult year when it comes to fundamentals, but it was exceptional when it comes to our results. Now, exploration, as you saw it, is going well. Production, we had a budget of 1.7 billion barrels. We lost something like 50,000 barrels. Felmo, Valdagri, Goliath, that had an initial downtime that was quite high. And the disruptions we had in Nigeria, we lost 55,000 barrels on average every year. However, despite this, in the year we managed to recover and we managed to meet the budget figure. But what is important is that the latest quarter we had our production record 1,860,000,000 barrels. If you take the production at the end of 2015 and 2016, you will see that we have a 15% of production growth. In 3 years, despite we cut cost by 37%, we increased our production by 250,000 barrels, which is a record ever since the beginning of Eni in terms of production levels. This is organic production coming from our discoveries, and so it is associated to a cost which is below 1, and so it has some intrinsic values. Now, there's something else that needs to be underlined, and which is quite important, and I'm referring to the midstream and downstream activities. The midstream and downstream activities are free cash flow positive at the moment. Now, mid-downstream produced free cash flow amounting to $2.6 billion. So that has been a strong contribution. The two main components which are used to assess the soundness of a company, which is represented by the cash neutrality compared to capex, The capex cash neutrality reached $46 per barrel. We managed to cover our capex with $46 cash neutral. Our target was $50, which was by itself very ambitious. We managed to bring it down to $46. And the most interesting, and if you wish, the unique side is represented by leverage, by debt. We were the only company that ever since the beginning of the big turmoil, that is the drop of the oil price and gas price, we have been the only company that managed to decrease leverage. At the end of 2016, the pro forma debt, ZOR included, is lower than the debt we had in 2013. The other peers, all included, we don't have the names, but we placed them on the chart, increased their debt by 20-50%. In red, you see the peers adopting scrip dividend. Without scrip, the debt would be higher. Now, we started off with a 25% leverage in 2013. We went to 24%. If you consider the deal with Exxon, our leverage goes down to less than 20%, which is the current Eni leverage. So this is basically a summary of our results. Behind this, of course, there is some hard work, but these are the results which we managed to achieve in 2016. At this point, we shall launch a video clip that will show the activities we performed over the past 3 years.
Bene.
Very good. So we move now on to the future. On the short term, in 4-year time. And then we will go where we'll have a leap forward, and we will talk about 2025 and maybe more. So these are the main elements of our plan. So we're going to talk about the conceptual points, and we will see them very rapidly. So we will base even in the future, our growth on organic foundations and bases. So we will keep on starting from exploration as the center of our growth potential. So it's an upstream growth that starts from exploration, that is always oriented towards the minimization of risks and costs, because obviously our activity has its own risks from an operational point of view. So our choices in order to minimize risks and costs start from the organic assets. So from the assets we know very well. So knowledge actually reduces risks, but we start also from other organic assets. So shale oil, ultra deep, HPIT. And so we went and we visited areas we knew very well. We used other geological models. We came back on areas that other abandoned, and we moves closer and closer to where our operations and our men and our knowledge and know-how about fiscal policies and other know-how of the nation allowed us to have a certain advantage from the time to market point of view. So this will still be our center and the center of our future growth. Talking about the operational part, well, yes, we said we want very high stakes, but we want to operate. We want to be operator. Why? Because we want to start from exploration, and we actually did invest a lot in technology. We invested in calculation technology, in actual tools, patents, in the upstream part. So exploration and the geological and physical interpretation and the reservoir part. So we want to operate in that area. As you've seen in the Mozambique case, Exxon, which is a very important player, actually acknowledged and recognized us and gave us the full operational okay. So for the joint venture, for the whole package of the upstream intervention in Mozambique. So we want to work on the design to cost concept that is actually usually applied to engineering. So when I think of a project, and that when I design a project, I think of costs on the long term and long time in order to minimize the costs during the engineering phase, but also during the maintenance phase, during the other phases of the cycle. So we have a 3 to 4 year cycle for a certain project. In that case, the design to cost has a time reference of 40 years. So it's an engineering concept, and we expanded it starting from exploration. So what does that mean? Our exploration, starting from the very concept, has this kind of filter, considering the very assets that can bring us to production more rapidly. So it's a very, yes, technical concept. The one of design to cost is a kind of engineering concept that covers the whole cycle, the whole industrial process, starting from exploration selection. So from the operational point of view, we have fast track as our model. So we want to have less idle capital as possible. We want to use these investment tools and transform them into energy. This is the fast track, and this still is our operational feature for our operations. Talking about the mid downstream part, which is a free cash flow positive part, which is increasing and growing as an EBIT. From the EBIT point of view, we will transform. We will carry on another transformation. We actually already started, but that will be implemented in the following years. You know that we are a very strong company from the GNP point of view, a European company, which is very much linked to the retail, to the midstream, and we are transforming our company to a gas and power company, which changes its model and links it more to the upstream. Why? Because we found much more gas in the upstream. So we found gas in East Africa, we found gas in Indonesia, we found gas in the Med area and in Venezuela. So we discovered gas everywhere. So the gas and power will be a company actually acquiring gas from other companies and reselling it, and a company that will develop an LNG business of owner gas. So, and we will be present on the whole value chain. We will be more and more linked and attached to the upstream, and this will guarantee us a very strong positioning in those countries where you have a very strong upstream. And we will market the gas. And so we will talk about gas anyway at the end of this presentation. Anyway, we will go on with our activity. We defined this activity as an active portfolio management, which is actually based on two elements. First of all, the M&A, which are linked to the dual exploration model and the transformation of our company. Let's move on, and let's talk about our targets. Yes, we have the quantitative targets, and these quantitative targets want to bring a result. It's the CapEx cash neutrality. We've seen that we achieved $46 per barrel as cash neutrality. And our target, our 4-year target, and it's very important, is keeping CapEx cash neutrality lower than $45 per barrel. So this will allow us to invest, to grow, even in low price scenarios, even in a growing trend and a trend of a growing and increasing oil prices during this 4-year period. So if we manage to keep CapEx cash neutrality below the $45 line, we will have very good advantage in the future as far as the free cash flow is concerned in the future. And yes, we want to grow. We want to have a 3% growth. What we said actually last year, the 3% we referred to last year, well, actually we have to consider that in the framework of the Zohr's disposal, we could get to 2.2%. Anyway, we found the necessary resources in order to maintain this 3% growth. Talking about exploration, we have an objective. The target is to find from 2 to 3 billion barrels in our 4-year plan. This will be sufficient in order to have that buffer to replace our production on the mid-downstream gas and power in 2017 at a break-even point, and then growing, and we will see how much. And then talking about refining, we will go on with our efficiency project in refining. That brought us to from $7.5 per barrel, and we're talking about the break-even margin, to 4.2 today, and $3 per barrel in 2018. And we want to increase our production, but we want to reduce our capex by 80%, minus 8%. So we will talk about this efficiency, about capex. It's not about cuts, but a more efficient procedure. And we'll talk about it. Talking about the break-even, global break-even on the project, the BEP is around $30 per barrel. On the financial part, well, I can tell you that our M&A global plan with dual exploration and other things will account for 7 to 7 billion. And our operational cash flow, the total will account for 47 billions in the 4-year period. Let's move on and let's move into some specific questions. Talking about exploration, for example, we have a map of the world, and you can clearly see where we will perform our exploration activities. We can divide this exploration as follows: 50% gas, 55% gas, and 45% oil. We have from 2 to 3 billion equity resources objectives. We will work in these countries with 120 wells drilled. And so the exploration is our basis, because this guarantees an organic growth, a low price, low cost organic growth. It gives us the flexibility to select and choose the specific projects considering the specific conjuncture and scenario, and this will give us some monetization in advance, as we've said before. Let's move now to the following slide, and we get to another very important component, FIDs. So the positive aspect and the positive thing about this very positive reserves, 13 billions. So we have some projects now which will be approved in our plans. We're talking about 22 projects. 14 of them are very close, and we will have a very long plateau for these projects, going far beyond the 4-year plan, and they will cover what will happen after 2020. So these projects are very key projects. So we have these projects, this kind of projects, but at the same time, we have other projects that will guarantee the growth after 2020. It's not the orange projects, it's the less mature projects you can see in the slide. Anyway, all these projects have a very important maturation level, and so from an engineering point of view, and they will be carried out in specific areas where we are present. There are no new projects in new areas, with the exception of Mozambique. Let's move to the following slides, talking about the startups and other projects for 2017. So 2017 will be a very important year. We will have the Kashagan ramp up, the Goliath stabilization. And anyway, we have 6 projects and 4 very important projects. East Hub in Angola. We were in Angola 2 days ago, for the inauguration of the in-production phase of this project, which is a very important one. And it's part of the new Eni fast track model projects. It's a heap offshore with a time to market 2 to 3 years. So we usually have from 4 years and a half to 6 years for the time to market. So it went in production in advance. The East Hub. We have the East Hub and the West Hub in Angola, and together with this ramp-up, they will produce 150,000 barrels. In June, 2 other projects will be in OCTP Ghana, which is an oil project for 2017, and in 2018 there will be a gas project for domestic gas use. We will have a ramp-up. We have 85,000 barrels capacity, and this will be the production. This will be a very important production for us. And then we have the Junk Creek, Indonesia, in June, with a very important time to market again, and it will produce gas. And according to our model, the gas that was discovered in a country where we already have LNG facilities, Bontang facilities. So we already have these facilities we can use. We can use these existing facilities, and moreover, the market is ready to get this and acquire this gas. We will deliver. Another project for this year, another of our giant projects, is Zohr. Zohr is very emblematic of our model because we did it and we made it very rapidly in 2015. In August 2015, the first discoveries. Then at the end of October, we went on with the FID. We drilled the second well in February 2016, and so in 5 months, which is usually 4 year, 5 year, 6 year, well, we made it in 5 months for the last phase. And so we will have the first gas production less than 2 years after the first discovery, so December 2017. So we did what our model, our conceptual model and theoretical model defines. So we worked in parallel. So we usually have the discovery phase, then the appraisal, and so on. We actually carried out the discovery, appraisal, and development phase in parallel, simultaneously. So we made 30 contracts for the long lead items and wells and many other things that actually take time to order. So we reduced that in 2 months. After 2 months, we already had that from the discovery. We already have had that. So all of this is very innovative things, and we realized them. And that were recognized and acknowledged by BP, for example, with a 2-year due diligence process, and by other very important global players. So it's a very important acknowledgement of our company, of our technology, and our model, and our geological model. and specifically Zohr geological model, which is very avant-garde and very innovative. Zohr will contribute, from the production point of view, with 75,000 barrels in 2018 and 125,000 barrels until 2020, and then 175,000 and more after 2020, with a very long lasting plateau. So it's just like Mozambique, a project that will give us a very important production contribution. So let's move on. And we can take a look at the production growth. We will not dwell into the details of all our projects. Anyway, you have the list of all the projects. In orange, you will have the new projects and the ramp-ups. And these projects will give us the production growth. In our plan, we have 650,000 projects that... No, I'm sorry, 650,000 barrels produced by these projects, plus 200,000 more barrels created by the production optimization of existing projects. So we will be able to create during the plan 850,000 barrels. So we will have this 3% growth in order to compensate our 5 or 6% depletion. After this plan, the very big giant, the orange ones that will be mature from an engineering point of view, will guarantee this 3% growth until 2025. So this year, with the definition and the designing of all the projects and all the reserves, thanks to these mature projects, we can guarantee the growth of during our plan, but also guarantee our future growth until 2025. So let's move on. We talked about production, new projects, and let's have a look now at the barrel and the cash flow per barrel. We have some costs. We said that these costs are very low, but what's the production in terms of cash flow? And we refer obviously to these projects. We have $67.5, and we have $29 cash flow per barrel. That's a very high. So we had $110, a $32 cash flow per barrel. So these projects have the 67.5 cash flow per barrel, thanks to the logistic costs, the exploration costs, and very limited costs. If we have a look at the legacy projects, our own production, our own projects, the value is $16 per barrel. So all these projects are actually creating value with an average cash flow per barrel of $67.5. So in the last 2 years of our plan, about $20 or $15 in the first 2 years of our plan. Let's talk about gas. And before doing that, let's take a look at the scenario. Gas has, for the time being, a very depressed situation. Less volatile than oil situation, because with the exception of the USA, we have very long-term contracts that cover these years. So until 2022, we will have to move into this covered market, covered by these long-term contracts. We have to make reference to the Australian projects, and so let's say that in the period after 2020, a certain space will open, and new projects could come in. We reckon that we believe in gas as a source, as a resource, and as our future, as a resource that can cover this power transition. We have these 2 scenarios: the US very much lower than the rest of the world, than we have in the East or Far East, who growing areas for the replacement of the old productions and new growing markets. So GNP, we talked about the break-even point in 2017, and then an important growth, 300 million EBIT for the period from 2017 and 2018, moving on to more than 600 million 2019, 2020, and more in 2025. So we talked about this GNP model. We are working actually on two areas: the conventional, traditional one, the European gas. The gas we acquire 89 billion cubic meters we use. It's our production. Some of that we buy. 50 in Italy and 50 in the rest of Europe. So we are working on this. We've been working on this for the last 3 years, and we want to get to the convergence of the contracts, oil-linked contracts on one side. So we had some oil products basket, and the other European, which are not linked to the oil price. So we are working on that, and 90% of this very high volume we market and commercialize, which is linked to the hub. And this allowed us to get to the break-even for many of our contracts. But we have to keep on working, because we've seen that the hub had very strong faults in terms of prices. And again, talking about the GNP, we're working on logistics. We had a reduction cost target, 150 million, and we got to 400 million cost reduction, and we already implemented a cost reduction at 200 million cost reduction. So we will have to go with the other 200 million euro reduction for the next 2 years. On the 4 years, with these operations, our target is to have a cash flow from gas and power of 2.6 billion. The third point, we will probably see it in this new slide, is the change of model as far as GNP is concerned. So it will still be a model linked to the gas we acquire, because we have long-term contracts. Yes, we are renegotiating these contracts. We will get to the break-even point. We will have some gain, yes. But the new model for GNP will be based on our own equity gas. So a GNP model that will allow us to grow in the global market, with the LNG global markets, and also where we have the best prices. We buy 3.5 tons of LNG every year. As far as the gas equity is concerned, we want to get to 10 million tons a year, coming from several and different markets, just like the Indonesian market, where we are growing. And Jangkrik is actually growing. We are carrying out, and we have carried out, close to the field, other discoveries. Zohr gas, Mozambique gas, or gas from Angola or Congo. So yes, we have several discoveries that will enable us to grow for the GNP sector. And starting from the equity gas, we will be able to stay and be present in the whole value chain without having to renegotiate contracts because with other people, with other players, because the gas is our gas.
which means a strong integration between upstream and gas and power. So an upstream integration versus the downstream integration that we have at the moment. Let us now move on to our chemical business, so chemical and refining business, which we put together to show you the results. As far as refining is concerned, our goal is that of obtaining a refining margin of 3. At the moment is 4.2. The refining business is going well. 2016, 300 EBIT, 2020, 600 million euros of EBIT. Now, like for like. If we consider, on the contrary, a different scenario, which kind of can be materialized in the future, we may go up to 900 million euros of EBIT in 2020. Now, as far as our chemical business is concerned, I do apologize. These are the results for refining business. What we are doing in refining, well, the most important activities are represented by green refining activities, by boosting Gela and Venice refineries. The other refineries are working at a great break-even point. We are now trying to optimize the Italian stocks, which are quite large, and so we are also working to improve the efficiency of our plants. Now, 3-4 years ago, these plants were around 65%. We managed to achieve 90% efficiency. So our goal is that of keeping that kind of efficiency. Our chemical business is going well, 300 million euros of EBIT, and this amount of EBIT can also be achieved even if commodities prices go up. Now, why do I say this? Because our chemical products have almost become specialties. So we have moved up along the supply chain from intermediaries. We moved up the supply chain, and we moved towards end product, which are also green in nature. These are also biodegradable products, especially when it comes to rubbers. We have elastomers and rubbers, which are turning into bioproducts. And this applies also to retail products. Now, the upstream and downstream will give us 4.5 billion euros of cash in the plan period. So let me dwell on this point, which I did not discuss in London, but I wanted to share it with you because we talked about 2020, 2025, but let's go even further, 2030. What I'm referring is the new UN resolutions. As you know, within our structure, we managed to achieve a solution which reduces the carbon footprint of Eni, which means the creation of CO2. And we do this in different ways by reducing flaring. In a while, flaring will go down to 0. We also reduced natural gas escapes or flights. We are doing this by adopting also a new model which is being applied in Italy and abroad, which is wherever we have operations and wherever the geographical fit allows us to do that, we will be using renewable resources. First of all, solar and photovoltaic cells. We should also use wind energy. But because of our nature, because of the countries in which we operate, like African countries, we are focusing on photovoltaic plants. We already have 14 plants in Italy, and we also have projects abroad in Pakistan, Egypt. We have already signed the agreements, and the capital for it has already been budgeted. Pakistan, Egypt, Algeria, Tunisia, and Ghana. We are discussing these projects in Angola, Mozambique, and Congo. So what is the underlying principle? Well, that's not the usual principle that you do renewable resources. You bid for tenders and you buy plots of land. We already have a lot of land, 4,000 hectares of area which have been reclaimed. These were permanent landfills, have been reclaimed. There is no possibility to build residential units there. In those areas that we already have and that we have already taken care of, connected to the grid network, very close sometimes to our refining and production sites, we are already starting. They're usually located in the south of Italy, Sicily, Sardinia, Apulia, and Basilicata, the most southern regions of Italy. We are installing solar panels. We have, as I said, 14 projects in the plan period. We shall be able to produce 220,000 megawatts, and the exceeding energy will be sold to the network at very low prices, and this will allow us to reduce costs. Now, the very same model, we're applying it abroad. And here we have something like 160 to 200,000 megawatts. In those areas we have land. We use gas to make plants work. The ideas have already been shared. The project concepts have already been agreed upon. The idea is that of replacing gas that we burn with solar or photovoltaic energy in countries where the sun shines frequently. Now, this reduces CO2 emissions, but it also frees up gas in countries in which we operate. So it's something that gives us more gas. Now, these projects, were it not for these characteristics, the renewable sources of energy production have a very low IRR. These are projects which are usually supported by public grants. Without these grants, they would have an IRR of 4.5%. Now, given the conditions I mentioned, we start with an advantage, and these projects have an IRR between 8 and 12%, which is very high. We have some 550 million euros in the plan to produce 460 megawatts for 2020. So a good and strong level of production. Now, I stop here, and I will hand you over to Massimo, who will give you the financial highlights. Now, thank you very much, Claudio, and good morning to you all. Let me give you some pieces of information more on our financial and economic performance and the plan, which has already been illustrated as far as business is concerned. Let's start from our CapEx plan. As we heard, our CapEx plan amounts to 32 billion euros. It goes down by 8% if compared to the previous plan, where CapEx amounted to 34.4 billion euros. So we are speaking of a reduction of around 2.8 billion euros of CapEx, which are broken down as follows: 1 billion, 1.1 billion related to the fact that we were faster in implementing the dual exploration model. We disposed 40% of Zohr more rapidly than we expected, and therefore we kind of got rid of 40% of capex. This reduces the overall capex for the plan. 2.3 billion euros are represented by a fine-tuning of our portfolio, and also our constant search for cost savings. Like for like, this will help us decrease our capex. What is important to remember is that the capex reduction in absolute terms, so a 30% decrease over the past 2 years, well, this will be achieved without compromising the evolution of our business, which is expected to grow. So you can see that upstream capex is going down by 13%, whereas our production target, as you heard, is going to stay at 3%, but even higher. If you remember, last year we had a growth that was somewhat above 3%, but that was before what we did in our portfolio. This 3% growth is after what we did to our portfolio, which also includes the disposal of 40% of Zohr. And you may understand that this, of course, provides a strong contribution to growth. So what we told, savings, fine-tuning the portfolio, and so on, well, is made up for other businesses, especially the renewable source of energy. Certainly, this will imply capex investments in a four-year plan. 500 million euros during the period. 80% is related to renewable source of energy. As you can see that most of this capex maneuver is related to the upstream business, 76%, but 80% of this capex are operated by Eni. Now, you may well understand that operating a project means being able to structure the project along the development lines that the operator intends to apply. And as you heard before by Claudio, our current development project is very different from the ones adopted by other peers. Had we not had 100% of the Zohr field, we could not have been able to carry out all of those activities in a short period of time, one after the other, as you heard. Now, 8 billion for 2017 out of these 31.6 billion euros. You will see minus 8% versus the previous plan, and then we maintain a flexibility when it comes to capex. These are not yet covered by contractual agreements. 50% of the capex that we expect to make between 2019-2020, as I said, are not covered by contracts. 50% is going down to 30% in the four-year period, by definition, because the activity for 2017-2018 are already associated contracts. But there is something positive to be seen here. The fact that we have managed to secure contracts for capex at the time when the energy scenario was at the very bottom of its cycle allowed us to obtain cost of procurement for projects which are certainly lower than what we expected 2 years ago. Now, the cost of the LNG floating of Coral, which was then secured by a contract, was almost 50% of the cost that we expected to pay 2 years ago for the same kind of activity. Let me now move on to give you some information about the disposal program and the portfolio management. Now, I will be telling you what we have been doing over the past 4 years, and then I'll tell you what we are going to do in the next 4 years. Over the past 4 years, our disposals amounted to 20 billion. If we consider also the disposal of 40% of Zohr that we signed in 2016. So, the overall value is 20 billion worth of disposals. 10 billions of this are related to our focusing on the oil and gas business. And here you have the disposals of the stake of Saipem, the payment of the debt, the disposal of Snam, and the other 5.5 billion euros are related to what we defined as our dual exploration model, the sales to CNPC in Mozambique and the sales or disposal of 40% of Zohr to Rosneft and BP. Now, in 2016, we sold assets for 2.6 billion euros. In the first year, we made 40% of our target, 7 billion euros, that we set for ourselves last year for our disposals for the period 2016-2019. So let's now look at the future. What do we expect to do? Well, we shall continue our rationalization portfolio policy following the very same principles that we followed in the past 4 years, which means rationalizing the Eni portfolio, focusing on oil and gas activities, and on the other hand, we shall continue with the dual exploration model. The dual exploration activities hasn't stopped with the disposal of Mozambique and Zohr. Over the past 8 years, we found some 13 billion euros of resources. These resources will be put in production within the Eni portfolio. In some cases, we still have some stakes on projects which perhaps are a bit higher than what we would like them to be, but these stakes will follow the same process that we followed in Zohr in Egypt and in Mozambique. Now, there are some minor components of our portfolio management policy, which are represented by a further rationalization of non-core assets in the mid-downstream business and a final rationalization of our E&P portfolio, which is represented by small assets which are still in production in areas, however, which are not growing considerably. And so we are thinking of getting out of those and to invest the money in areas which are associated to stronger upsides or stronger growth potentials. Now, let me now give you some information about the cash flow. So, trying to summarize what we have said so far when talking about the industrial development, optimization of our business or portfolio management policy. Well, the cash flow is expected to grow regardless of the underlying scenario. So if we assume a flat scenario at $57, which is the average between 57 and 60, which is the price of the Brent oil that we expect in 2018. In 2019, 2020, we expect 65.70. So that's the average. Without considering those $10 more, the last 2 years of the plan, cash flow is expected to grow, as you see. Now, in the first 2 years, 17, 18, in 2016, our cash flow was 8.3 billion euros. In the first 2 years of the plan, we expect the cash flow to go up to 10.5 billion euros. So we expect a cash flow to considerably grow during the first 2 years, which will be connected to upstream production. The projects mentioned before, OCTP, Jangkrik, Zohr, the ramp-up in Kashagan and Goliath, all of these activities will help us achieve this cash flow level. But this will not be it. Like for like, we expect the evolution of production, which is growing, will contribute another 1 billion euros of cash flow from operations in 1920, 1919, 1920. This is not the result of us betting on starting production in certain fields, but it is rather the consequence of ramping up those fields where we have a greater visibility. These are the fields that we expect to start production in 2017, particularly. Something else that can be added to this figure. First of all, the scenario, because this can actually account for a first kind of upside, $10 on average of the Brent price oil for our projects. Well, this means 2 billion euros of cash flows from operations more. Another upside is represented by the portfolio. Part of the portfolio is what I've just described and the goals associated to that. But when it comes to the portfolio targets, we have included the disposal of a residual stake of Saipem. We are not including the disposal of the gas and power retail business, especially the Italian one, which is the largest. And we're not factoring in the disposal of our chemical business. We're not cashing in even the 10% that we gave to Rosneft and BP as an option. They have a 5% option each to grow by the end of 2017 their stake in this project. And so the flexibility that we have in managing the cash flow is certainly connected to these factors, and for this we feel somewhat reassured. So we have a big upside if the scenario is confirmed or it is better than what we expect, but we are somewhat well covered if the oil price trend gave us less positive surprises. Again, to recall you our flexibility, I said that we have a 35 flexibility of capex, which can be used as a flexibility tool within our portfolio, thus being able to spend money based on the cash requirements that we have and based on production activities. Let me tell you something about our remuneration policy. Is the same to the one that we declared 2 years ago and last year. Our policy is or envisages a growing remuneration based on the achievement of industrial results that we presented, but also based on the scenario. The two elements of the scenario are represented by price and stability. You know that stability can also lead us to the use of different remuneration instruments or tools. So we confirm our remuneration policy, which is somewhat sounder than it used to be before, because the results that we have so far achieved confirm the expectations underlying this policy. First of all, the fact that we have achieved a cash neutrality, both for capex and dividends, at $50, including disposals. That was the goal we set for ourselves in 2016, and we're now confirming it. The fact that we are capable to maintain the cash neutrality at $60 in 2017 organic, without considering the disposal of 25% stake to Exxon, and then a cash neutrality below $60, and we expect this decrease to be progressive in the subsequent 3 years between, as you can see, 2018 and 2020. So these are the preconditions. On this basis, the dividend that we announce for 2017 is again a full cash dividend, 0.8 euro cents per share, and we confirm a remuneration policy which is going to be progressive based on the evolution of our results and the evolution of the scenario. Now, the slide I showed you before, this on the cash flow plan, gives you an idea of the extra cash that we expect. Once we have covered the capex and the dividends, 0.8 euro cents means 2.9 billion euros in absolute terms. How do we intend to use the extra cash? We don't have a policy which sets priorities as somebody else does. We have room for different things. We certainly confirm a policy whereby our remuneration is progressively growing, but I think that we have the possibility to adopt a growing remuneration policy, but also we have the possibility to grow our business, because in our portfolio we have the huge amount of resources that have been discovered, which can be even greater when it comes to them being transformed into reserve and production. So this is an organic possibility for us to secure for ourselves growth. But then what is important is that the projects be cash accretive. Now, Claudio showed you a slide about projects that will give you new production in the next 4 years, provide a stronger than average cash contribution. So we want to improve the cash contribution of new projects. The projects will start production if they are cash accretive, or at least if they generate cash at the level that we expect. And at the same time, we would like to maintain a leverage level between 0.2 and 0.25, which we believe is a sound level of leverage. I'll give you back to Claudio for the conclusions. Thank you.
Grazie, Massimo.
Thank you, Massimo. And yes, in my conclusions, I would like to talk about what we can expect from Eni and what will be our main focus in the future. So what can we expect for this 4-year plan and these 4 years? It's a very good and strong cash flow generation. Considering all the projects we've seen, this is one very important target that can give us an important added value. But the other thing we will focus our attention on is our discipline, our economic and financial discipline. When you have to manage all these resources, all the resources we've discovered, all this very big capex volume, all these explorations, well, you have to do that with a very strong and severe economic and financial discipline. When we seen this $43 cash neutrality capex value level, well, this will be our obsession, I can guarantee you. We have a whole cascade process ongoing that will give us the possibility to break down everything we've been saying today at the different levels of our company. So this discipline won't only be a financial and economic one. It will be very conscious and cautious about the risks. It's difficult, yes, but we have showed you that we managed to decrease by 37% our costs, and we have increased by 15% our production, so it's not impossible. And at the same time, we will go on with our reorganization, and we have two important components that need some attention and some reorganization in order to redefine our activity. It's GNP. We have there a very strong potential, and we want an organic growth in the GNP sector, as we've done for the upstream and in other sectors too. And then The other one is it's the integrated oil and gas from the upstream to the marketing of oil and gas with an integrated approach and everything that Massimo has said. Anyway, we have a very strong and robust company, but we haven't expressed completely our inner value concerning the retail gas, for example, which is not included in our plan, but it does. It's a part of our strategic vision in order to give more value to our company, even in the chemicals sectors, from a strategical point of view. I don't want to talk about Saipem. This is a operation that will give us the possibility to get out of Saipem, but this is not what we are talking about here. But we have gas and power and retail and gas and chemicals. These are all operations that will grant us an additional value, but we will keep our discipline. We will be very cautious and careful on that. We will now conclude our meeting with a video, and after the video we will go on and move on to the question and answers.
Adesso domande e risposte.
Let's move on to the question and answers. If you have questions, otherwise we won't give you any answers.
Sono stato così esaustivo.
So, have I been so exhaustive? No, we have one. Good morning. I'm just referring to the disposal plan, 5 to 7 billion, 2.6 you've already created, and so we have more to go. So is this a conservative assumption for you, considering the last 3 years? So can we expect something more from this disposal program, considering your early monetization assumptions and facts? What we've been saying during these 3 years is very exceptional, but we know that it can be hard to replicate. Well, you know, a plan is not, no, it's not a conservative plan, but it's a plan that was designed on the basis of what we had in our hands on the table and on the most probable figures. So we have other explorations with important stakes in West Africa and the Far East. And then we have the whole part which is related to the new discoveries. So Zohr, for example, we discovered at the end of the plan, and then at we sold or we disposed as well. So it was not what we expected in the beginning of our plan. So now we have some known assets having a strong potential that can be actually sold. So the ones that we've given you are the most probable figures. Our structure from the investment costs, the balance sheet, debt and so on, point of view is very robust and sound. So I think that we are doing good, actually. And if we have some opportunities, these opportunities will be seized to add more value to our projects. The Mozambique's operation gives us some cash in, but at the same time, there are other assets. We have the technology, the installations, the facilities, and so on. And it's an added value, actually. Zohr's action and transaction is an added value one. We have many synergies with BP and other synergies in Egypt that can be doubled, and our effectiveness is doubled again. So the dual exploration vision is, yes, the cash-in part and the added value potential one. Yes, maybe there's some margin to have a better performance than the one we expect. Yes, we have to consider some upstream events and facts, and yes, and we have to consider all the asset management on that part also. So we do not only have the dual exploration one.
Sì, c'è un signore lì.
Well, I had a question on costs and on capex. Obviously, the costs in our industry went down and fell in the last year. So, are we going to see a further reduction of the costs, and so a further reduction of the capex in your 4-year plan? Maybe the oil price won't get up to 70. Maybe just will go only to 60 or 65. So what will be the cash flow of the company in that scenario? And even in terms of break-even point, so if we don't get to 70, but if we get to 60 or $65 at the end of 2017, what are the consequences of that? About the capex and costs, the industry during the last 3 years got to minimal points. We've seen some very strong LNG costs decrease. We got from 2.5 to less than 1. So on the long lead item parts where we had some drilling and other things, we had sometimes a 40 or 50% decrease in reduction in costs. We are very close to the actual cost of the outlay cost. So yes, about the services, we had a certain stabilization of the reduction. I don't think that we can get much value out of that. Concerning our reduction of costs, 8% on the plan and 16%, as Massimo said, versus 2016. Well, we have designed that without considering a further reduction of costs. We just used the flexibility of our exploration, our assets that can bring us to have lower costs. That's why we fixed less than $43 as our objective and our target as far as the capex cash flow is concerned, because we are designing that considering our assets and this cost reduction scenario. Yes, maybe we can have a further reduction of costs, as you said, maybe, but I'm not sure about that, because we had a certain recovery, even if slow recovery of certain projects. So on the onshore shallow waters, for example, are actually recovering. Talking about the neutrality, the cash neutrality point you raised, I think that, yes, concerning the break-even margin of our projects, as you've seen and as we've seen, we had some existing projects having a very important return, very big return. We're talking about $32 of cash flow per barrel, and then 67, which are actually equal to the one had $110 per barrel as a level. So these projects have already defined their costs. Let's say that these are kind of closed projects that are not very much influenced by scenarios, current scenarios and future scenarios. The question of the oil price and our capacity, we have one of the most conservative scenarios, $50 this year, and you've seen our average is $65 to $67 for the next 2 years, so very low. Maybe we won't have this low scenario. We have a season seeing some closing of refineries for 5 to 6 million, and the storage. Yes, the market is very anxious, actually. So they said, well, we got to 49, we got to $33 the same period in last year, due to many closing of refineries. So we have to consider that. And the first 3 months of the year are the lowest price ones. So yes, we have some anxiety in the market, on the market. And we have 1.4 million as far as the demand is concerned, kind of stable. We had some problems in getting there in China. And we have OPEC at 1.2 million, and it's very likely to have an imbalance supply demand in June. And we still have some storage adjustments to go for many products, but we still are conservative. Yes, we expect a year and a half of stabilization, and we will have 500,000 barrels more this year. Even if we get to 1 million more barrels, we don't have some projects and covering them. So this is the scenario we've seen, considering the cash neutrality. And we are, yes, a little bit conservative, but we think that this way is safe for us. A more specific question, can you give us some idea about what you intend to do on the chemicals as far as the disposal programs are concerned? And another question, do you think that the new president in the US will have an impact on the global scenarios? About chemicals, the answer is very easy. There are no ideas of ongoing or future disposal program. We are focusing on the industrial part. Chemicals are doing fine. Even in these first quarter, and the fact of being able to create a long chain, even in considering the stock costs, higher stock costs, and the joint ventures abroad are performing very good. The free cash flow positive again in this period. The data we've given you, we've seen a constant 300 million EBIT, and we are very positive about that. And we have no ideas, no specific programs in that sense. About the United States, and well, we have some actions and operations in America. But we are, let's say, more an African and Middle East and Far East company. So we are very much oriented to these areas. So what can be the impact of the US presidency? Considering the United States and the American market, before and after, we have a very low price gas. And gas will be the key element as it's been for the last 10 years. So gas actually replaced carbon and coal. And this trend will go on. So we won't have to promote this hydrocarbon. It's a self kind of promotion. And so as far as the promotion is concerned, well, there will be some optimization for the transportation of gas and the pipe and so on. But in the last years, American oil and gas was very strong and powerful, very powerful. They are developing new refineries. They have new oil, new gas. They are exporting oil. And products they used to import, now they export them. So it's difficult to say they're going to be more performative. And no, I don't think so. So from this point of view, an important economy and a growing economy having its own energy with low price, well, this is a very competitive one, a very competitive economy, very different than from Europe, and from our situation in Europe, where we don't have our own energy. We import 50% of our oil, and then 70 and 80 and maybe 100% of gas we use. We use coal, because other sources are too expensive. So the impact of the United States, well, will stay the same. They are very powerful because they are self-reliant. And so I don't see any change in that. Or I don't think that the political situation will have an impact on a very strong performance. It's very hard to have a better performance than that.
Grazie. Io avrei tre domande. La prima sulla...
Thank you. I have three questions. First of all, about depletion, slide 14. The long plateau projects, are they going to see a change in the depletion date after 2020, or will it remain around 5 or 6% as it is now? Second question about gas and power. What is the percentage of equity gas that you expect at the end of the plan as a percentage of sales? And then leverage. You spoke of an ideal level between 20 and 25. With the latest farm out, you are below 20%. If things go as expected at the end of the plan, based on my calculation, it will go down to 10 to 15%. Are there areas where you see spending opportunities, or are you reassured by this level? Well, we never rest, we're never reassured, because otherwise we'll be finished. Let's speak of depletion first. Now, at the end of the plan, we have some 2025 projects, which are long-term projects that have constant plateaus, which means that after 6, 7, 8 years, there's a slight drop, 2, 3, 4%. Of course, there is also production optimization. But then we also have legacy projects that we have been exploiting for 40, 50 years. I can't quantify mathematically all of this, but based on my experience, I can say that the new projects are stronger and have a stronger plateau than the previous ones because they are big, giant projects. The new projects are all giant projects, and they will give us quite a considerable base log. In northern European countries, in the United States, in some African countries, we have some shorter projects. In the Gulf of Mexico, we have projects with a plateau of 1-2 years. I think that this will be made up for, but I don't think you can do better than a 4-5% of depletion, considering the project package that we have. And so the more you produce, the greater the variability. Below 4%, I don't think you can go when it comes to depletion. Now, equity gas at the end of the plan, your second question. Well, the equity gas at the end of the plan will be related to Egypt, Zohr, probably. Zohr will start the production and will have the possibility to use also the Unus extension, which will have a lot of gas in Egypt, and we will have the possibility to export gas. I can't quantify that exactly, but it's going to be a few million tons more. We have 4 million tons, so we might have some more million tons that can grow. Now, the calculations that you've made, I don't know whether they are correct or not, but what I can tell you is not so much what we are going to do with that money, because since we have a huge volume of barrels and huge amounts of gas, I mean, we know where to invest, but we're looking at things opportunistically as well. When we see something interesting, well, that has to be compared to what our break-even level is. We have a technical cost chain which is well below $20. $1 exploration, $2 operating costs, $11 development costs. So looking around the world, assets at these costs is not very easy. But then we have to consider contracts, and you need to find assets that you can buy and which are already producing or which will enter production at these costs, because we will not buy assets that will dilute our results. We have legacy projects that are worth $16, so we have made efforts over the past 3 years to go up to 29 with certain projects. We cannot buy at less. If we have opportunities that can give us synergies and which will help us increase our critical mass, well, these are investments that we can make. Otherwise, our investors will ask us, why are you investing money there? But then these opportunities are to be assessed on a one-by-one basis. We, assess these opportunities also with our M&A office that sees these opportunities on a daily basis, but they have to be really interesting opportunities in order for us to exploit them. Okay, if there are no other questions, we can close. There's another question there, yeah? No, I have another question. You answered all my questions. Now, I read different things, somewhat contradictory in nature. Can you tell us what the situation is there? Well, the situation is actually contradictory. There's a big evolution. Things are constantly changing. From an operating point of view, we have operated in an area that has been quite stable, And then we have the advantage that we supply gas to the domestic market, and we do not use terminals. There's a pipeline that goes to the power plants in Libya, and there's a pipe that goes under the sea and reaches Sicily. And so we have an activity which is related to logistics structures and those activities that help us produce. So that's Eni. And then Libya, where there is a government which is at the moment recognized. And then we have another component in Tobruk, which is changing somehow the situation. Some terminals are lost, some other terminals are gained again. I think that the future of Libya in the future will depend on external influences. There are different interests and varied in nature. We've heard the United States and Europe that want Libya to be united, which is going to be a solution for us as well, because if Libya is united, it will take away some territories from terrorism. The southern part of Libya is very difficult to control, and there are these terrorist movements. And so if Libya is united and is well controlled by a strong government, will take away room for maneuver to international terrorist forces which are ever present in the country. So I think that the big powers or neighboring countries or international organizations should have a common goal. From that point of view, Libya can find peace and can be reunited, but you don't have to fuel internal rivalries. Now, the situation is changing day after day, and it's always us, meaning people from outside Libya, that fuel this instability. This instability is not fueled by itself. You know, if you have a car, you have to use gasoline. A body, in order to walk, needs energy. I think you understood what I meant, although I did not give you a direct answer.
C'è ancora una domanda.
So we have another question to go. Yes, you recently acquired a block in Cyprus, which is active in Zohr. Can we expect some developments and similar developments on that? In Cyprus, we have 3 blocks, and 2 other are under discussion, number 8 and number 6. And Total actually acts as the block 11, and they are all in the same line and very close. So Total that had 100% asked us to have a 50% stake and to work with them. So everything was born thanks to Zohr and the facilities and the structure. We will look for these blocks. Will be structures having some structural and geological features very similar to Zohr. So that's the end. Thank you very much.